Thanks so much for tuning into this conversation. We are trying to assess the extent of damage, if you will, that some of the recent moves by IT companies have had on the sentiment, or do they indicate something more grave from an IT services business perspective? Or conversely, could that actually be viewed slightly positively as well? To talk about that, two men from the industry, or rather from the analyst in the institutional investor industry, Sumit Pokharna, VP of Fundamental Research at Kotak, as well as Sandip Agarwal, ED of Institutional Equities at Edelweiss. Gentlemen, both of you, thanks much for taking the time out and speaking to us. At the outset, Sumit, what do you make of this move? Let's start off with the first move and then we move to the larger picture. If indeed companies are holding back variable pay, would you view this constructively, or would you view that this is a sign of further margin pressure?
There are two angles to it. One is that the supply side pressure has eased a little bit with that first angle. And secondly, on the other hand, if you look, it is difficult for the companies to pass on the cost, inflated cost to its customer. So for the orders which they have already won. So, and if you look at the EBIT margin, they have been under pressure for the last 3 quarters continuously. So I guess this is one of the ways the companies can look for maintaining their margins.
Mm-hmm. Sandeep, what's your house view out there? I mean, and thanks for joining in, of course. What's your sense of what does this move indicate?
See, thanks for having me on the show. I have worked in tech industry for very long period, and then I came to sell side. I'm in sell side from last 10-11 years only. So I will tell you some things. The noise which you are hearing right now, it is in last 6 to 6 quarters, it has not happened because this industry has seen sudden spike in demand, so much demand from all the corners, like from FANGs were recruiting madly. EPAM, because of Ukraine-Russia war, was recruiting, and Indian IT companies have not built any bench. They have not recruited pre-COVID for 3 years because of low growth in the industry. So they were also trying to fill their benches and all those things. So all the pressure came together in the industry. And also, if you go by data, 10 years back, our industry in 1.2 million engineers used to pass out, and it has fallen to 800,000 because the recruitment pace was very low. In fact, some of the beginners' pay of IT industry was lower than some of the factory worker pay also. So that was the situation 2 years back. So no one was willing to be into this industry, and because of that 1.2 million engineer which used to come out fell to 800, 900,000. And then suddenly all the demand from all the sides came together post-COVID. So there was a big gap between demand and supply, which led to huge jump in attrition rates. And because of that, we saw that in last 4 quarters, as Sumit rightly said, in last 4 quarters, EBIT margins have collapsed by average 400 to 600 basis points, depending on the company. And if you directly see the correlation, it is directly related with attrition, because attrition for a company like TCS has moved up from 8.9 to 19.4% in just 4 quarters. So the replacement costs are very high, the financial interventions are very high, and or if you see the breakup of how the margins have gone, all the margins have gone only from employee cost side, which includes subcontracting cost. There is no other cost which has gone up. Everything is same except this cost which has gone up. So obviously, now what is happening is that with FANG's demand going down a bit and also startup ecosystem not recruiting aggressively, the demand situation has cooled off a little bit from the manpower perspective. I'm not saying from revenue growth perspective. So it is a positive sign. Now, how do you read what things have happened from the large cap in last few days that they have holded back the variable pay and all? Now, because there is a negativity and there is a fear of recession and all that, so people are reading only that it from that perspective. I come from this industry. Many a times it has happened in the past where variable pays are held for 1 quarter, then paid in the next quarter, and this is a normal thing. It has not happened in last 6 quarters because of very high demand. But before that, it was an industry norm. But by the end of the year, everyone gets everything. So, it keeps on postponing, preponing, and all those things happen. But by end of year, everything is paid out. So I don't read into this too much. I will also tell you this kind of news only stops good investor from investing. I will give you a classic example. When COVID came, if you go and see data, there was a small period when Wipro was not decisive whether they want to give the dividend or not, or do the buyback and all after the COVID, and then they decisively came and did everything. So we have to avoid this unnecessary noise. Demand for technology across the globe remains as robust as it can be, and also I will give you data. If it is tech bubble bust, post tech bubble bust, or whether it is post Lehman crisis, whether it is post COVID, 1 or 2 quarter demand could be here and there. But structurally, this is the lowest possible way to execute technology globally. we are the software factory of the world. There is no other option with anyone. So I don't see. I think this is a great opportunity. Margins will bounce back very strongly in next 4 quarters. You will see margins again going back to where they were 4 quarters back, and these stocks will all do well. This noise, I don't read too much into it.
Okay, Sumit, is your view the same? And it could be different, by the way, but do you reckon that margin could actually go up? Because the last 5 days, I've seen very converse notes from your peer sets, from the peer set of both of you. Some believing that there is going to be continuous margin pressure, and some believing that margins would come back the way Sandip was talking about.
So our view is that margins have bottomed out here, and from here we will see some improvement on margins, but it will be in a gradual fashion. Secondly, how the currency will pan out in terms of cross-currency effect, that's a separate chapter, but otherwise, broadly, margins have bottomed out here.
Okay, Sumit, just a follow-up here. So do you believe that this ability of the company at a point of time when the only talking point was attrition for the last 4 quarters, and the ability of the company to hold back variable pay is a signal that the attrition pressures are easing?
Definitely, I had spoken to a couple of people in the industry, and they have highlighted that earlier they were finding it very difficult to recruit people for 6 months also. But now that supply side issue has been taken care of, and there are they are getting good talent within at least 1 or 2 months. So I think there is supply side pressure which has gone down, which is good for the industry also, because you just see the employee cost plus subcontracting cost for few companies has gone as high as 70% of their revenue. I think these numbers are not sustainable. Plus, the people were taking letters and taking hikes everywhere. So that thing is also been has to stop somewhere. So I think this is the right thing which companies are doing, and this will eventually lead to a healthy growth for the industry.
It probably didn't just happen in IT, it happened in media as well. Maybe it happened in the brokerage industry too. People took letters and then took jobs elsewhere. Sandip, so come in here. I mean, the dichotomy in the conversation that we had with companies in Q1 was stark. A bunch of large caps had chalky commentary. A couple of mid caps said that maybe it's happening with some other players in the industry, but they were very confident of their own internal dynamics shaping up well. What's the sense that Edelweiss about how to play the IT space now?
So see, I don't go by what people are saying. I go by data, and rest everything is noise. You have to see the data of last 22, 23 years, how things have happened. And same thing keeps on repeating every time. There is no change. So right now, if you see, when an upcycle starts, the biggest beneficiary always is the one who can do the pilot projects in the new technology, right? So that is by default a mid cap or small cap. That is how the cycle always begins. But when the technology gets proven, then the large caps are the bigger beneficiary because they can execute at scale. And when a down cycle also starts, it is exactly similar. So I think that in this industry, what is the only asset you have? That is manpower. So manpower tells you everything about the industry. So if you see the data of last 22 years, you can catch with only attrition data as a lead indicator, the upcycle, the down cycle, the upcycle for margins, the down cycle for the margins, and the upcycle for growth and down cycle for growth. You don't have to see any data because that is the only asset through which you are generating. Like in manufacturing, you need to see the capex to know how the things will pan out in next 3 to 5 years, the growth and all. Same thing here, the capex is basically the manpower, how you are recruiting, how your attrition is happening. If you see that data, you don't need to see anything else.
Sure.
If you see how attrition, I would say that people may say negatively, but there is two type of attrition in this industry. One is good attrition, one is bad attrition. So when the attrition goes up for the industry, it is always a very positive sign that the very strong demand is going to come. But then that attrition also has to remain in a range. So if you exclude TCS for their methodology, but if you, in my view, 15 to 20% is the sweet spot for attrition. If the attrition is between 15 to 20%, it is a clear indication that demand is very strong and you can manage margins as well. But if it is beyond 20%, then it becomes very difficult to execute and also manage margins. Large caps are able to do the execution part because they hire subcontractors, they have the balance sheet and the P&L to support that. So they don't falter on execution. So they manage the revenue growth, but they falter on the margins, exactly what has happened in last 4 quarters. In mid cap and small cap, what happens? They try to manage the margins, manage the revenue growth or execution for some time by hiring subcontractors, but beyond that, they also have their limits. So they start faltering on revenue growth also, or execution and margins both. That is exactly what you have seen in the last results. And that is where the dichotomy of the commentary is that large caps are talking okay on the revenue growth, but margins, they are not seeming confident because they don't know how long the attrition problem will be, and they will keep on hiring subcontractor and they will not go, falter on the execution because the relationships are long term. On mid cap, they have their limitations. They are trying to manage both. So, their comment is little differentiated from that. And a small cap commentary will be probably at the worst because the margins are at their worst. So I would say that, wait for this quarter numbers. When numbers come, you will see much more relief. You will see growth remaining where it is. Will be a healthy growth. And see again data. Infosys has upgraded guidance. By the way, Accenture has upgraded guidance, by the way. So we have to go by data. You will again see upgrade in this quarter, in my view, on the whoever is giving guidance, they will upgrade the guidance. And margins will see a massive bounce, I would say. I'm very confident that in next 4 quarters, you will see back the margins which were there 4 quarters back. So I'm expecting a 300-400 basis margin recovery in next 3 to 4 quarters time, because all margins have gone to manage the manpower. So that manpower is now getting managed. The supply side problems are getting put up. So margins have to come back because pricing already is there in the numbers, but it is not showing up because of the high attrition.
Okay. Sumit, is your view similar or is it different? It's good to be different. Just a rephrasement of my question would be, when I say large cap, I want to not just talk about the 5 nifty names, but also some non-nifty names which are now no longer mid caps, right? Market caps of over 25-30,000 crores doesn't quite make them a mid cap, maybe a small large cap. So large caps and small large caps, if you will. What's your sense there?
So we have highlighted in the past in our notes also that talent shortage, high attrition or fresher induction, high subcontracting charges and wage revision, some of these headwinds will become tailwinds when the talent situation eases. So that's what we are going to see in coming quarters. First, secondly, there was a significant drop in utilizations because of fresh hiring. I think that going forward, this utilization will also improve for a few of the companies. So considering these 2 factors, I think even large mid-cap companies should do well going forward.
Okay. So very quickly before we wrap up, Sumit, start off with you. Your pecking order, if you can. I'm not asking you for a buy or a sell. Just on your published reports, what's the pecking order that you guys have put out, if you can share?
Yeah, our top pick remains Infosys and HCL Tech and large cap. And tier 2, we like Emphasis.
Okay. And Sandip, same question to you. If you can mention, not a buy or a sell, just the pecking order at Edelweiss.
I like the whole sector. I think huge money will be made in next 3 years, but still I will tell you my pecking order. In large cap, I like HCL because it is a value pick. I like all the names, but I would prefer at current price in HCL, Techem and Wipro, while I continue to like Infy and TCL. In the mid cap, I like because of the valuation Coforge, but I again like Mindtree, LTI as well. In the small cap, I like Gensar, First Source. I like Cyient also, but these are the preferences.
Got it. Gentlemen, lovely having both of you. Thank you so much for talking us through what seemed to be a very news-heavy day, but maybe the market has taken it slightly conversely. Much appreciate your time.
Thank you.
Thank you.
And viewers, thanks for tuning in.